Good afternoon for me, maybe morning, noon, night for you. We're just going to run through some of the profitability ratios. So there are three profitability ratios that you need to remember. There are gross profit, net profit, and then we have the return on owner's equity. So we're going to look at just gross profit and net profit to begin with. So this is the worksheet that we got in class, or maybe you've downloaded it, that you can get access to it. So we're just going to run through each question, model them, and check out how we do this. So I'm actually assuming, though, you've already looked at the formulas for each of the ratios before you do these sheets, because I won't talk too much about them. I'll assume that they are knowledge that you've already got. So our first question in this task asks us, explain what is meant by profitability. An answer to that is probably going to be pretty short because we've got 2 lines there, and on average we're saying every 1 mark is worth about 2 lines. That's just a general principle we use for our exams. So to explain what is meant by profitability, we know that profit is the money made above and beyond all expenses once they're paid, and it's a simple calculation of revenue minus expenses equals profit. But to explain what is meant by profitability, we could simply turn that into words. So, explain what is meant by profitability would be to say that profitability is the amount of money, and let's use a business term in brackets, let's say revenue left over after all expenses are paid. We've got our 2 lines, and to the point. It does say explain, and explain's a pretty high order term, but 2 lines means it's going to be pretty short. How do gross profit and net profit indicate profitability? Alright, that one you really need to understand what the core of the ratio is. And for gross profit, which we'll just call GP, which isn't always the best thing to do, we should really write the whole thing. But in this case, how does gross profit indicate profitability? Gross profit indicates profitability through revealing how much of our revenue is actually lost to COGS. In other words, COGS is the cost of goods sold, the cost of manufacturing our goods, but just the material side. So GP, gross profit, indicates profitability through revealing how much we spend on making our product and what's left over after that. Net profit is slightly different to that, because net profit comes after gross profit. You've got to remember that from your income statement. Now, net profit indicates, and it's going to be the same thing, whoops, let's spell it correctly, indicates profitability through revealing how much of our sales, or revenue rather, how much of our revenue is lost to all our other expenses. And then whatever's left over shows us how much we got left. So C, if we've said that, we can now calculate our gross profit ratio. That was the first 2 questions, just a bit of a tester for your knowledge. Part C, though, says calculate gross profit ratio for 20x2. Now, I'm hoping that as soon as you see gross profit ratio and you see the formula for it, which is gross profit over sales, you will remember that gross profit and sales appears on the income statement or the profit and loss statement. So in our example here, you're normally given it. We've got our title up top, profit and loss statement. So we know the money is, we know that the answers, the information, has to be wrapped up in this financial statement. So we just need to remember our equation, which is gross profit over sales. Okay, which also kind of times 100, but if you're not sure why we do that, I'll cover that in a second. So really just gross profit over sales equals, alright, we've got to look at our template, our financial statement, gross profit, and it's 20x1, 20x2. Make sure you know what the question is asking. we're looking at that year. Gross profit for that year equals $290,000. We've got the 1,000 marker there, so we've got to add the 3 zeros to the end, but it's 290,000 over sales for that year. So sales in our top row says 600,000. 600,000. All right, now to do that, you're going to need a little calculation, and that requires, unless you're a genius, a calculator. Now, what I'm not a genius of is I didn't have my calculator sitting next to me. So I'll just grab that. We've got my calculator, and we've worked out 290 over 600 comes out to be 0.483 repeated. Now, we don't really need the 3, we really just want to work with 2 figures. So 0.48 is going to work for us. Now, what does 0.48 mean? It doesn't really mean a lot to us. And now, we're called financial ratios, so you'd think that they'd all be ratios, but they're not. There's a mix between ratios and percentages, and then, to make it even more interesting, one that refers to days. But just remember, for our ratios for gross and net profit, we deal with percentages. And that's where the times 100 comes in, because we want to times our final figure by that 100 so that the decimal point jumps twice and we get our percentage of 48%. That's it. That's all it's asking. Calculate the gross profit ratio, and we've done that. So good job, peoples. All right, question D. Calculate the net profit ratio for 20x2. All right, calculations almost exactly the same. NP, net profit, over sales times the 100, because we're dealing with another percentage, equals net profit. If we jump down, that's at the bottom. It's the final leftover, 145,000. And our sales, we know again, is still our 600. So 145 over 600 equals, that is a good question, 145 over 600 equals 2416, 0.2416. Okay, now we really only want to work with 2, so we're just actually going to get rid of that. And 0.24 times our 100, turn it into a percentage, which makes number 2 zeros, so therefore we jump the decimal point twice, becomes 24%, and we have our answer. We haven't been asked to comment or anything, just calculate, and that's what we've done, so we can stop there. Now let's go on to E. Use the gross profit ratio to comment on the business's profitability in 20x2. Now this word comment simply is asking us to say, really just say what the ratio means, or our percentage in this case. So our gross profit ratio, if we go back, was 48%. Okay, so a gross profit ratio of 48% is good or bad. That is generally how I like to start these comments. So you say, make it very clear, is it healthy, is it weak? Saying good or bad is probably not the most business-like word, so we want to sound businessy, because you want your market to kind of be impressed and think you really actually know what you're talking about. Not just think, but know you know what you're talking about. So a gross profit ratio of 48% is actually relatively healthy. So we could say, 48% is healthy for, what's the name? Huxley Partnership. For Huxley Partnership. Now, that's kind of commented, but it's not really enough. We've got 4 lines. We're being tested here for probably 2 marks, so we really need to add a little bit more detail. What does 48% mean? That will be our second sentence. So sentence 1, generally just say on a comment, is it good or bad? Is it healthy? Is it poor? Then in your second sentence, actually say what 48% means, or what your ratio means. So in this case, this is because 45% of all sales is being, or really it should be, are being converted into gross profit. And this tells our reader/marker that we actually understand what the ratio is telling us. Because it's the gross profit ratio, it's telling us how much gross profit we are generating from sales. If it's the net profit ratio, then the answer tells us how much net profit we're generating from our sales. Okay, good, well done. So, next question. Use the net profit ratio to comment on the business's profitability for 20x2. Okay, again, comment, 4 lines. We're just going to do the same thing. Now we know that net profit here is 24%. And we're just going to follow the exact same sort of template, because why change what works? So, comment on the profitability. A net profit ratio of 24% is, let's say, healthy or strong, is positive. So let's go healthy for Huxley partnership. Okay, sentence 1. Sentence 2. This is because 24% of all sales revenue is being retained or being kept, is being converted for, or let's say, as net profit. Now, to be honest, we don't completely know that 24% for net profit and 48% for gross profit is healthy for the business. We're estimating just on what our knowledge is. Because let's be honest, 48%, almost 50% of all sales revenue, just a little over 50% of all sales, the cost is going to manufacturing the product. Now, generally manufacturing is relatively expensive, so that's why a higher sort of gross profit percentage is kind of okay. Now, you could say that's bad because it's costing us, we're losing 52% straight away. But, you know, you can justify that 48% depending on what the product is. It's, you know, we could say we don't actually know what they're producing, so we don't actually know if it's good or bad. But we do know that it's being converted and retained in gross profit. So it's, as long as we're showing that we understand what the ratio means, the percentage means, then we're okay. That's really good. The further we go on in the harder questions, that's when we really need to start proving how we know it's good or healthy, and we'll get to that. Suggest how this business could improve its gross profit ratio for 20x2. That's where we get to the strategies chapter. So I'm going to leave that for now. Suggest how this business could improve net profit ratio. I'm going to actually leave that for now. I am just going to say one more thing though before I finish, which is if you really want to find out if 24% is good or 48% is good for gross profit, the best thing to do is look at the previous year's figures. So let's just do a little very quick sample here. 20x1, let's just look at gross profit, because net profit ratio will work exactly the same. So let's just take a look at one and you can transfer it to the other yourself. Gross profit for that year is 480,000 and sales is 700,000. So just down here, let's just draw a little box. So GP over sales, we're going to do it for the year 20x1. So gross profit 480, sales 700. So 480 over 700 equals, on our calculator, 68.5. So 68, well, it should be 0.68 to be honest, shouldn't it? But then we times it by 100, and that gives us 68%. Now, let's have a look at this. In 20x1, 68%, in 20x1, 68% of our sales was making it through to gross profit. Now that's pretty good. But here in 20x2, it's actually dropped to 48%. So by looking at a previous year's figures, the year before, we can see that the business actually isn't in a great position. So our statement that it's healthy actually becomes false if we compare it to another year. Now, we haven't been asked to do that yet, so that's not something you have to be concerned about when it's just asking you to comment. But if you have been asked to comment on the difference between 2 years, or if you've worked out the ratio for 2 years, for 20x1 and 20x2, and you know the ratio for net profit or gross profit, then talk about it. Compare the two to say which one's good, which one's bad, or if it's just stable and consistent. All right, I hope that's helped you. That's it for me for now.